Okay, so I also want to thank the organizers for including our paper in this conference. This conference has been a tremendous amount of fun so far. We'll see how much fun the next 45 minutes of it are. So this is joint work with Lillian Mills, who's in the accounting department at the University of Texas at Austin, as well as with Erin Towery, who's also in the accounting department at the University of Texas at Austin and is sitting here as well. Okay. So sort of broadly speaking, the research question that we want to answer in this paper is how things like operating performance and financial structure evolve after companies go through leveraged buyouts, after companies are acquired in leveraged buyouts. Okay? Now, leveraged buyouts have been around for a long time, and yet understanding how these companies evolve after they go through buyouts remains an important question to try to answer, okay, for a variety of reasons. Okay? First, the economic magnitude of these transactions is very large. Okay, so if we look in just 2006, okay, which was kind of the peak of the most recent LBO boom period, approximately 3% of the U.S. stock market capitalization was taken private. Okay, so it's important to understand what happens when large chunks of the publicly traded economy are taken private and levered up in these types of transactions. Okay? And yet, we still have nothing in the way of a consensus in terms of whether these transactions are good or bad, okay, among academics and among policymakers. And to see this, you have to look no further than the ongoing Republican primary in the U.S., where Mitt Romney, for his work in doing buyouts with Bain Capital, has been characterized as everything from a capitalist hero to the devil himself. Right? So, given that we have no consensus, we have no real closure to this debate that's been ongoing for quite a while as to how we should regulate and tax the private equity firms that undertake these types of transactions. Okay? And finally, sort of in recent years, big pension funds, big public pension funds have increased the amount of their holdings or the amount of assets that they hold in these private equity funds. And so I think it's important that we understand what type of assets our public pension sector is heavily exposed to. Okay? Now, a number of papers have tried to look at what happens after leveraged buyouts previously, so we're not the first paper to try to do this. Okay? And the big challenge that you run into when you try to look at what happens after LBOs is that these firms are by definition private after they're acquired in LBOs. Okay? And private firms in general, at least in the United States, are not required to disclose public financial information. So there's a lack of public financial information available to try to assess what happens after an LBO. Okay? Now, existing papers have tried to get around this problem in three different ways. Okay? So first, they've studied LBOs outside of the U.S., where firms are required to disclose public financial information, even if they're private, okay? Which is useful for understanding what happens after LBOs, but the U.S. remains the biggest and the most active LBO market in the world. Okay? So it's still important, I think, to understand what's happening in the U.S. specifically. Okay? The second approach is to study non-financial information, okay? For example, to use census data, which is very useful for understanding things like how employment levels and factor productivity change after a leveraged buyout, but ultimately don't allow us to look at things like financial performance and financial structure and how these things evolve after a buyout takes place. And then the third approach is to study these relatively small samples of firms that go through LBOs and do still have some public financial information available for the period after they go through an LBO. Either because they have public debt outstanding, and so they're required to file public financial information for that reason, or because they subsequently go through an IPO, and when they go through an IPO, they disclose historical information that covers part of the period while they were private. Okay? And so this is useful for understanding things like how financial performance and how financial structure evolve after LBOs. Well, the thing I think we have to be a little bit concerned with these types of samples is that they may be non-random, that they may be selected samples. Okay? You're looking at firms that either have public debt outstanding or that subsequently IPO, and it's not clear that we can extrapolate from these types of firms to LBOs more generally. Okay? So the big innovation in this paper is that we're going to use IRS corporate tax return data, okay, to analyze the performance and financial structure of firms after they go through LBOs. And we're going to look at LBOs between 1995 and 2007 in the U.S. Okay? And the advantage of this data is that it covers approximately the universe of firms that have total assets of at least $10 million, whether they're public or private. Okay, so we're actually going to be able to look at what happens to these firms after they go through LBOs, even if they don't have public financial information available. Okay? Now, at this point, what we're focusing on is a sample of about 317 publicly traded firms that were acquired in LBOs. And at the end, I'll talk a little bit about the other things we're working on to try to kind of move this paper along. And one of the things that we want to do is also look at what happens after LBOs of firms that are already private, okay, which is something about which we know very little at this point. Okay, so this is a good time to put up the disclaimer. So the views expressed in this presentation and the associated working paper do not reflect the opinions or positions of the IRS. Okay? And so the first question we're going to try to answer is how LBOs affect operating performance. I don't know why I got a chuckle out of that. Okay, so I think this is a very important question to try to answer because it tells us something about whether or not LBOs add value in the sense that they actually improve the efficiency of the firms that go through these types of transactions. Okay, so I think it's sort of a first-order question to try to answer. Now, why would we expect that an LBO might affect the operating performance of a firm that's acquired? Okay, well, Jensen in 1989 argued that this sort of LBO structure was superior to the public corporate structure in trying to deal with the moral hazard problems that we see in firms that might have a negative impact on the efficiency or the operating performance of the firm. Okay? And Jensen, in fact, argued that this type of structure would eventually eclipse the public corporate structure, okay, which I don't think we've seen happen up until this point. Okay? We also know that private equity firms maintain fairly large operational staffs. Okay? So we sort of found some news articles that suggested that some of the larger private equity firms have operational staffs of 60 or 70 people. Okay? And I know from talking to my MBA students, students who are interviewing with private equity funds or private equity firms, okay, they say that the very first question that they're asked now is what sort of operational experience they have. Okay? I do think that this is a bit more of a recent phenomenon. It's not clear that there was as much focus on operations, say 5 or 10 years ago as there is now. Okay? All right, so what does the existing academic evidence have to say? Okay, well, we know that there are relatively large improvements in operating performance after management buyouts, okay, which is a particular form of leverage buyouts in the 1980s. Okay, so Steve Kaplan has a paper on this. There are a few other papers that have looked at this. Okay. When we look at LBOs in the 1990s and 2000s, so Guo, Hotchkiss, and Song have this nice paper that's in the Journal of Finance, and what they find is that there are still sort of improvements in operating performance in the U.S. In LBOs in the 1990s and 2000s, but that this improvement is more modest than what we see back in the 1980s. Okay? Now, both of these papers, again, are looking at samples of firms that have public financial information available. Okay? And so potentially face this issue that it's hard to extrapolate from these results to LBOs in general. Okay? And we see mixed changes in performance after LBOs in Europe. So I think in the UK, we see relatively little improvement in performance in the 1990s and 2000s after LBOs. In countries like France and Sweden, I think we see much larger improvements in operating performance. Okay, so what do we find? All right. Well, we start off by looking at our entire sample of these LBOs of publicly traded firms. Okay? And what we find is very little evidence of an increase in performance after these firms go through LBOs. Okay? Looking sort of in the period of 2 to 3 years after the LBO takes place. Okay? So we don't want to sort of look at these things just in absolute terms. We want to compare them to some benchmarks. So when we do things like industry adjust, when we compare the change in performance to industry median changes in performance, or when we compare changes in performance to changes in the performance of control firms, okay, we find that there's at least some evidence of some small improvements. Okay, and I'll be specific about what I mean, but the evidence here is relatively weak. Okay? All right, so we might imagine that you're sort of looking at LBOs in general, okay, that the scope for improving performance may not be that great in a lot of these transactions, right? If a firm is already very profitable, maybe there's not a lot of scope for improving performance. So we're separately going to look at LBOs, okay, that were unprofitable before the LBO took place. Okay? And we think these are firms in which the scope for improvement is relatively large, all right? And when we look at these firms, we do in fact see large increases in performance measures in that 2 to 3 year period after the LBO takes place. Okay, for example, pre-interest return on sales increases something like 12% in median terms from the year before to 2 years after the buyout takes place, okay, which is a large increase. Okay? And when we compare this to the industry median increase in performance, we find similar results. But when we compare the change in performance to control firms, a sample of control firms that come from the same industry and have similar operating performance before the buyout takes place, okay, these are firms that didn't go through a leveraged buyout, we find, in fact, that this result more or less goes away. okay? That when you compare them to these control firms, that there really doesn't look like there's an increase in operating performance relative to the increase in operating performance in these control firms, okay? Which suggests to us that there's something like mean reversion that's going on here, right? So you've got a firm that's unprofitable, and it goes through a leverage buyout, and its profitability or its performance seems to increase quite a bit, okay? But when we look at similar firms that didn't go through buyouts, their performance also increases quite a bit over the same time period, which would suggest that these firms are just sort of facing mean reversion in performance, and they're coming back up to kind of a baseline level of performance that they would have come back to anyway, even in the absence of a buyout. Okay, all right? So the second question we're going to answer, or try to answer, is how capital structure evolves after a leverage buyout, right? So by definition, an LBO is going to lead to a large increase in debt and leverage, okay? But the question is whether firms continue to maintain this very high level of leverage, this very high level of debt, after the buyout takes place, okay? And I think answering this question is going to tell us something about the motive for the financial structure of these transactions, for why there's so much debt used in these transactions, okay? So the existing evidence on how capital structure evolves after a buyout is much more limited than in the case of operating performance evolution, okay? So Steve Kaplan has a couple of papers that sort of produce different results on what happens after a buyout in terms of capital structure in the 1980s, and we're not aware of any papers that look at this for the 1990s and 2000s. Okay, so what we find, I think this is a very striking result. We were a little bit surprised that this is what we found, but we find that LBO firms on average don't reduce either their debt or their leverage at all for a period of up to about 5 years after the buyout takes place. Okay, so they maintain this very high level of leverage that they take on at the time of the buyout. Okay? Now, again, we might imagine that some of the firms that go through these buyouts just don't have the capacity to pay down their debt. Right? They've got all these interest payments that they're having to make, and that's going to limit their ability to pay down debt even if they wanted to. But we're also going to look separately at firms that are generating positive excess cash flow after the buyout, and we find that these firms also are not paying down their debt. So even firms that appear to have the capacity to pay down their debt don't appear to be doing so after the buyout takes place. Okay? We also find that if we look 5 years after the buyout, only about 40% of the firms that go through these LBOs are actually paying taxes, compared to about 75% the year before the LBO, okay, which is consistent with their maintaining a very high level of leverage. Okay? We also do a little bit of work where we're looking at dividends, and we only have dividends in our data for the last few years in our sample period, but we find that at least for this sample period, LBO firms pay surprisingly little in the way of dividends. Okay, so to sort of kind of put a wrapper in some sense on what we can learn from these results, okay, we find that when we're sort of looking at LBOs in the 1990s and 2000s, there doesn't seem to be a lot of evidence here that these firms, these LBOs are creating value by improving the operating performance of the firms that are going through them. Okay? We also don't sort of think that there's much support for the idea that LBOs are this kind of great solution to the free cash flow problem. Okay? We don't see an improvement in operating performance. I haven't sort of mentioned this yet, but we also see that these firms in our sample actually grow a little bit after the LBO. So it doesn't look like they're trying to divest negative NPV assets that were acquired before the firm was taken private in this transaction. Okay? And we also see that these firms don't appear to be paying down debt even when they generate excess cash flow. So one of the sort of variants of Jensen's story was the idea was you want to lever these firms up beyond the capacity that they can maintain over the long run. And the idea is you're giving managers very strong incentives to generate positive cash flow so that they can pay down the debt that's acquired in the transaction. Okay? And we just don't see that paying down of that debt. Okay? So financial engineering, in the sense that you're trying to sort of intentionally increase the amount of leverage in the capital structure of the firm, seems like it's a big part of what's going on in the 90s and 2000s. Okay, so let me talk about the data. All right. So we start by gathering from SDC and DealLogic LBOs of publicly traded non-bankrupt companies that have at least $10 million in assets in this period from 1995 through 2007. And we start with 479 LBOs that we obtained from these two databases. Okay. We then go through and search news articles to remove misclassified LBOs, LBOs of REITs and partnerships. Okay, they're not going to be in our tax return data. And LBOs of firms that were immediately merged into another entity, because we're not going to be able to do an apples and apples comparison in those cases for the before and after. And that leaves us with about 354 LBOs. Okay? So the next step then is going to be to try to match these LBOs up with the business return transaction file that we get from the IRS. So this is the tax return data. And we start by using the employer identification number, which we get from CompuStat. And we're able to match some of the LBOs using the EIN. Okay? Where we can't match by the EIN, we try to match by the name. Okay? And there's still quite a few cases where we can't match everything up, even using the EIN and the name. In particular, this is a problem in the post-LBO period because these firms often change names when they go through these transactions. Okay, so we're going to use news articles then to try to track the names of these firms over time so that we can match them in both the pre and post-LBO period. Okay? And I think that this sort of exercise turns out to be relatively successful because out of the 354 LBOs we start with, we're actually able to match 353 of them. Okay, so this is basically the universe of these LBOs during this period. Okay? Now, we're going to need to have some pre-LBO data and some post-LBO data available in the tax return data to do the type of analysis we want to do. Okay? So I'll sort of show you how much data we have over these kind of different windows around the time of an LBO where the LBO takes place in year T. And we're going to focus primarily on this sample of about 317 LBOs where we have data available both the year before the LBO and the 2 years after the LBO. Okay? And again, this is something like 89% of the initial sample of LBOs. So this is, again, fairly close to the population of LBOs during this period. Okay? And you can see that we obviously lose some observations as we go further out in time. Okay, so the first question, again, we want to ask is how LBOs affect firms' operating performance. Okay? So we can think of a lot of different reasons why LBOs might improve the operating performance of these firms. Okay? Reduces the free cash flow problem. This creates some discipline, reduces wasteful investment. The concentrated ownership in an LBO structure facilitates monitoring. Private status of these firms allow them to focus more on the long run and less on the short run. And maybe these private equity firms have some operational expertise that they're able to bring to bear to improve these companies. Okay? On the other hand, we can also probably think of reasons why an LBO might actually harm the operating performance of a company. Okay? The leverage that's being taken on might create financial distress, okay, which could ultimately choke off positive NPV investments. Private equity firms might come in and sort of effectively loot the firms that they buy out and leave them unable to function in a positive way. We also lose an observable stock price when a firm goes private in an LBO, and this could have a couple of effects. First, it may make it more difficult to use executive compensation contracts where there's no longer an observable stock price. And second, we also, if the stock price is generating information that's feeding back into the firm's decisions, we're now losing that source of information. Okay, so let's actually look at the results. All right, so what I'm plotting here is the trend in pre-interest return on assets for the full sample of 317 LBOs where we have data both the year before and the first 2 years after the LBO takes place. Year T is the year of the LBO, and I'm going to kind of ignore year T because it's effectively a blended year where the company was public part of the time and private the other part of the time. And these lines depict the median level of pre-interest return on assets. It's the red line. The green line shows the third quartile, and the blue line shows the first quartile. Okay? And what you can see here, again, sort of ignoring what's happening in year T, is that if anything, we see sort of a slight decline in pre-interest return on assets around this transaction the first couple of years. Okay? We also look at pre-interest return on sales. Okay? That's what's depicted in this picture. And we see something fairly similar. Here, there's maybe a slight increase in pre-interest return on sales around the time of the transaction. Okay? So we want to sort of test statistically to see whether these changes are statistically significant or not, okay? Which is what we're going to start doing in this table, okay? And I'm going to do this for 3 different ways. First, we're going to just sort of look at the absolute change in performance, the unadjusted change in performance, okay? Then we're going to industry adjust. So we're going to look at the change in performance, and we're going to compare that to the industry median change in performance around the time of the LBO in the same years. And that's the second thing we're going to look at. And then the third thing we're going to do is we're going to come up with a control sample where we're going to look for firms in the same industry that have similar levels of operating performance based on these measures in the year before the buyout. And we're going to compare the change in performance for the LBO firms with this control sample of firms. Okay? So starting off by looking at the unadjusted sample, and we're going to do this over different periods up to 3 years after the buyout. And when we look at this on an unadjusted basis, in absolute terms, we don't see any statistically significant changes in pre-interest return on assets here. Okay? And they're also what we see are numbers that are relatively small, so less than 1%. Okay? When we industry adjust, we start to see a little bit of maybe improvement in performance, at least in terms of medians up to 2 years out. Okay, but again, this is less than 1%. So the magnitude of these effects still seems relatively small. And when we adjust for control firms that have similar levels of performance, we again don't see any improvement in performance here. Okay? So in some senses, this is kind of one big non-result. Okay? The same thing for pre-interest return on sales. We find maybe a little bit more evidence that there's some slight improvements in performance, but the results here again are sort of very weak. Okay? We also have a measure of pre-interest economic value added. Okay, so here we're just basically penalizing firms for the amount of capital that they're using at any point in time, and the results here are consistent as well. Okay, so again, those are the results for the entire sample of LBO firms that we have. And we might imagine that there are some firms for which the scope for improvement in performance is bigger, and those are particularly going to be the ones that we'll call these loss LBO firms. They were the ones that were unprofitable pre-LBO. So now I'm going to show you the same set of pictures for just these loss LBO firms. Okay? And what you see is, at least if we look from the year before the buyout, year T-1, to the 2 years after the buyout, we do see what look like pretty big improvements in operating performance. Okay? Maybe not so much if we're looking from 2 years before the buyout to those 2 years after the buyout. Okay? This again is pre-interest return on assets, and we find a very similar picture for pre-interest return on sales. Okay? And so when we actually look at these things in terms of tables, we see, again, on an unadjusted basis, just in terms of the absolute improvement in performance, we do see a pretty big increase in the median increase in pre-interest return on assets, something on the order of, say, 4 to 5 to 6% in those 3 years from the year before the buyout to after the buyout. Okay? When we industry adjust, okay, the effect actually gets a little bit bigger, so the improvement in performance actually looks a little bit bigger. Okay, but the big thing here is that once we adjust for the performance of these control firms that have similar operating performance on these same measures before the buyout, we see that this result largely goes away. Okay, which means that these control firms that are not getting bought out, that were unprofitable before the buyout, are also experiencing improvements in performance of about the same magnitude as our LBO firms are. Okay, which at least suggests that these LBO firms might have improved their performance on their own, even if they hadn't gone through a buyout. Okay, if we have a good control sample. Okay. Similar results when we look at pre-interest return on sales. Okay? Here that the magnitudes on an unadjusted basis are actually bigger, okay? But again, they more or less go away when we compare them to this control sample of firms that doesn't go private in these transactions. Okay? And the same thing with pre-interest economic value added. Okay? All right, so what we're doing in this table then is we're going to take these different change in performance measures, okay? And we're going to look at the performance-adjusted change in performance measures. So this is comparing them to the control sample of firms. Okay? And we're going to regress this sort of change in performance relative to the control sample on a bunch of different factors. Okay? And the one that we're most interested in focusing on is the first one, which is this prior profit indicator, okay? Which takes a value of 1 if the LBO firm was profitable before the buyout, and a value of 0 if it was unprofitable before the buyout. And what this table shows is that firms that were unprofitable before the buyout do seem to do better relative to their benchmarks, relative to these control firms, than ones that were profitable before the buyout, even though if we sort of look at them and just by themselves, they don't actually appear to experience an improvement in performance just on their own right, or at least not a very big one. Okay. So our takeaways then from this analysis are that LBOs at best sort of generate a small positive effect on operating performance. Okay? And there's some evidence that there's perhaps no operating performance improvement at all. Okay? We do see some operating performance improvements in firms that were unprofitable for the LBO, but not relative to benchmarks. And we do see, again, this sort of effect that the firms that were unprofitable do seem to do better than the ones that were profitable before the LBO. And we've looked at longer time horizons. There you have to worry a bit more about about survival issues, but we find similar results. Okay? So next we look at capital structure before and after the buyout. Okay? And so the big question we want to sort of get at here is why so much debt is used in leveraged buyouts. Okay? So one possibility is that the objective is just to effect a permanent shift in capital structure. Okay? Either firms are under-levered before the buyout takes place, or perhaps the objective is just to increase the expected return on these buyouts, and maybe the limited partners in the buyouts just don't understand what the leverage effect is. Okay? All right, so if this is the case, we would expect to see that the change in leverage that we see in a buyout is going to be long-lived. In other words, it's going to last for several years after the buyout. Okay? On the other hand, maybe the objective is to create high-powered incentives. There, the idea is we want to load these firms up with debt and force managers to earn their way out from under the debt load. And there, I would sort of suggest that if we see firms generate excess cash flow, we would expect to see them pay down their debt. And finally, maybe there's a transactional motive for using so much debt. Okay? So Axelson, Stromberg, and Weisbach have a paper in the Journal of Finance that argues that the reason for using outside debt to finance these types of buyouts is that it reduces the adverse selection that the limited partners investing in private equity funds face. Okay? And in that case, I think there's at least some chance we would expect to see firms paying down their debt after the buyout if the objective is purely transactional. Okay? So let's see what happens to the debt to assets ratio after a buyout takes place. And again, this is for our full sample of firms. And what we see is that we do see a big jump in debt at the time of the buyout. It's a big jump in leverage, which is not surprising, from year T minus 1 to year T. But then it remains relatively flat in the years after the buyout. Okay? And this is also true if we look at only firms that have positive excess cash flow in the year after the buyout. Again, these are the firms that presumably have the capacity to pay down debt if they choose to do so. Okay? We also look over longer time horizons. Instead of just looking 2 years out, maybe this is not enough time to see the pay down in debt. Okay, and we find that even over longer time horizons, granted that we lose some of the firms in our sample, but we don't see any paying down of debt over longer time horizons. And this is true as well for firms that generate positive excess cash flow. Okay. All right, so this is what we've shown you so far is the debt to assets ratio. Now maybe what's happening is these firms are paying down their debt, but their asset level is also falling. Okay, and we also find that that's not true. But what we also want to look at is debt as a percentage of debt in the year of the buyout itself. And I apologize, the X scale here is sort of off by 1. So this sort of point here is year T. Okay, and by definition, debt as a percentage of debt at the time of the buyout is 1 in year T, in the year of the buyout itself. Okay, but we again see that debt doesn't seem to be decreasing in the years after the buyout. And this again is true for firms with positive excess cash flow. Okay? We also look at the percentage of these firms that are paying taxes in any year after the buyout. So you see that a lot of these firms are paying taxes, about 75% before the buyout, and we're down to about 40% after the buyout, and that remains at about 40% for up to 5 years after the buyout. Okay? All right, so the sort of takeaways here are it sort of looks like the purpose of debt and capital structure in these buyouts is intended to just affect a long-lived change in the amount of leverage that the company has. Even firms that generate excess cash flow don't appear to be paying down their debt. Okay? Also, that the LBO dramatically reduces the likelihood that these companies are paying taxes in any given year. And I think these results have important implications for researchers who are trying to study the value of the tax shields that companies take on in LBOs, because they have to make assumptions about how long-lived the debt is after an LBO. And our results would say that the assumption that you want to make is that the debt is basically permanent at that point, or at least over the first 5 years after the buyout. Okay? I'm going to sort of skip through a couple of slides here in the interest of time. I do want to sort of show you what happens to dividends for at least these 5 years in the sample where we have information about dividends. We see that the amount of dividends that are getting paid, this is as a percent of transaction value, in the years after a buyout are very low. So for example, if we look at the third quartile of distributions, okay, in the first 2 years after the buyout, we see no dividends being paid out. Okay, and we start to see some small amount of dividends being paid out once we get to the third year, looking at the third quartile. If we look at the median, it's basically zero. Okay? So these firms don't appear to be paying out big dividends over this period, but then again, part of this period is the financial distress period, so maybe this is not representative of what we would see over earlier periods. Okay? I've got a few slides here that just show how these companies grow in terms of their assets and sales after buyouts, and basically what they show, and I'll sort of tell you what they show in general, is some small amount of increase in size after the buyout. Okay? Not a large, but certainly not a decrease in size. Okay? So I'll sort of go through these very quickly. I'm going to skip this slide. So to sort of wrap up, we see very little in the way of improvement in operating performance after leveraged buyouts in the US between 1995 and 2000. These firms don't appear to be reducing either their leverage or their debts in the year after the buyout, even if they generate enough cash flow that they could presumably do so. We see very little in the way of dividend payouts over this sort of small period where we have that evidence. We do see some evidence of growth after the buyout, and we don't see any support for this sort of free cash flow argument for LBOs. Okay? Now I've got one more slide, and I want to say a little bit about, and I'm going to do this, I'll wrap this up in 30 seconds. Right? Some of the things that we're trying to do to sort of push this paper forward. Okay? So one of the things that I think we're going to end up doing is splitting this into 2 papers. Okay? You've sort of seen that it's hard to present this whole paper in 30 minutes as it is. We've got a lot of results. So we're probably going to end up with one paper on operating performance and one paper on capital structure. And here's sort of a laundry list of some of the things that we want to do, some of which I've already mentioned, going forward over the course of the next couple of months. Okay? All right, I'll stop at this point. Thank you.